Hola, mi gente. Welcome back to another episode of Latino Investor. Today's going to be a special episode because we wanted to start kind of like a new podcast style on this channel. So today, I'm actually going to present to you guys Daniel Rodriguez, which is a really special friend of mine. We actually went to school together,
Yeah, we
and,
did.
and, and Daniel's kind of been the behind-the-scenes person of this channel. You know, it's been me for the most part, but we thought we'd introduce Daniel because he's such a pivotal part of the channel as well as kind of my investment philosophy, and we kind of bounce ideas off each other. So
For
I,
sure.
I, I thought it would be a good idea to bring you on and
Yeah.
introduce you to the viewers and see who's behind the camera.
Yeah. Thank you so much for having me on the podcast, and I'm just looking forward to this new series. Hey everyone, my name is Daniel Rodriguez. As Mal mentioned, I've been a part of the Latino investor community for pretty much from the beginning, right? Once it started. I'm doing sort of more of the back end, sort of behind the scenes stuff, from the social media things to, I mean, really we kind of do it all.
Yeah.
Mal's more camera facing, but this is me taking a step into that camera facing piece of it. So I'm just looking forward to this new series, man.
Yeah, and this is the whole team as of right now. We're just two guys that like to talk about finance,
For sure.
and we happen to be Latinos, so
And we happen to be good friends as well.
yeah, exactly. So it's really a laid back,
Yeah.
kind of hobby that we're
Um,
doing right now. Being transparent, trying to motivate, people in our community to start thinking about investing
For
because
sure.
we believe strongly that it's one of the best ways to build wealth. And so, Daniel, let's talk a little bit about how we met.
Yeah.
We mentioned we're really good friends and we met in college. Aside from that, we also have the Ford Family Scholarship.
Yes. Yeah.
So, the Ford Family Scholarship was such a pivotal help for us because it helped us really graduate college without having any debt.
Yes, I think that's so game changer, and I'm very grateful for what the Ford family has done for us. And just to give some context to the audience of what the Ford family is, it's a need-based scholarship, financial scholarship that pays for, was it 90%
Yeah.
of your unmet cost over the course of 4 years, which is an amazing scholarship, to say the least. And the fact that we've been privileged enough in that sense. I mean, we worked hard for that scholarship, but to graduate with no debt from a 4-year sort of private institution is insane, and I feel like that has sort of really jump-started my financial and investing journey as well. Just the fact that pretty much any sort of payments that I would have had perhaps to student loans, I kind of just put that towards my investments. And that's not to say if people have student loans, they can't build generational wealth,
Right.
or whatever the case may
Right.
be. But I acknowledge the head start that I've had in my life.
Yeah, and in investing, one of the biggest things that we've kind of talked about is that you got to have a why. Why do you want to start
Yeah.
investing? You kind of have to have the end in mind. And for me, aside from wanting to have financial security for my own family, I'm married, so I'm looking to start a family, and I'm looking to be in a position so that my family doesn't have to worry about finances. Because growing up, we were both lower income,
Yeah.
so finance and money, it's kind of tight.
And sort of taboo as well.
And taboo, yeah.
It wasn't really talked about.
Exactly, and growing up, that wasn't to say that we never had a food on the table.
Yeah.
Like my parents worked really hard to provide the basic necessities, but sometimes there's not enough money to do other stuff. Like especially when our friends would go on trips and all this stuff. Like we wouldn't be able to do that kind of stuff because there wasn't enough of a margin to cover our necessities and then do this. So for me, I wanted to provide a little bit more financial security, and we've been in a blessed situation to be able to do that. But aside from having that end in mind, like a big why I started investing is because I want to get back to the same
Yeah.
programs that helped me get to where I'm at today. Because I feel like if it wasn't for all that help, not only from the Ford, but other programs and individual people and just organizations from back home, back in Southern Oregon, like if it wasn't for them, I wouldn't be here today. And what I see myself, aside from providing for my own family, is being able to give back to those programs, in the form of funds
For
you know,
sure.
like I think it'd be really awesome if I could, you know, donate money to the board because,
For sure.
you know, they really helped me be in this financial situation.
No, for sure. Like shout out to all the people who helped us on our journey, you know,
Yeah.
to come out here. And I think there's a saying like it takes a village or whatever to be able to sort of raise a kid, but I think it also takes a village to really, you know, build someone up as well. And the fact that we've been given those opportunities is amazing. And, you know, I know we've talked kind of offline, off camera of like even how it might look to might maybe start something like that, you know, start a scholarship fund. I think paying it forward is so key, and always remembering sort of where you came from and not forgetting that is like your special sauce as you go through this life.
Yeah, yeah, and you know, starting a fund would be super awesome, you know, and you know, I'm not really in a situation to do that now, but like you know, in the future that'd be super cool, you know, like you. In college, I was, you know, looking to go that pre-med route. You know, growing up, I was like, you know what, this is what I want to do. You know, this is the way I give back to my community is by offering, you know, by going to school to be able to offer services like being a doctor. And, you know, that's very difficult. And I went through that route and I realized that it's more difficult than I thought. And maybe I'm not cut out for it. And I know I'm still young and I can still go down that route.
Yeah.
But I'm kind of also exploring this idea of, you know, maybe setting up something like this, you know, having like financial programs that help, you know, not only just people from back home, you know, I think, you know, this is kind of me just thinking, you know, kind of crazy dreams at this point, but I think it'd be really cool to have like whole regional or national programs or even help donate to those already existing programs to help more people get started on this financial journey because, you know, I think it plays a pivotal role, you know, student loans, you hear about all these people that have to pay all this money back. And, you know, it's really scary because if I were in that situation, I would also be very like stressed out, you know, not having much margin to invest especially. So, so being able to give back to the community by, you know, establishing programs like that or giving money to those programs would be awesome. You know, I feel very fulfilled and I think I'm kind of exploring that idea as well as, you know, giving back through maybe some medicine.
For sure, dude. No, you touched on like the reason sort of why you started things like this, like the Latino Investor. Like I remember when you first called me up and you're like, yo man, like I've been thinking about starting up a YouTube channel and having like a, you know, financial literacy type of thing and sharing it sort of with the Latino community, which is normally a community that doesn't really talk about finances and financial literacy and how to build generational wealth. Can you talk a little bit about like what was the motivation behind starting something like this, you know, and sort of how that's going?
Yeah, you know, we listen to a lot of the same people on YouTube. So, and I'll keep saying this again, like I think starting with the end in mind has been one of my things. And so for me, wanting to give back to my community, I was like, well, how can I do that? Can I do that through medicine? Can I do that through finances? Educating people on how to start investing. And I thought, you know what? You know, there's people on YouTube that make videos about finance and general personal finance advice. You know, why not just make a YouTube channel that kind of caters to Latinos or maybe catering is kind of difficult because most of the advice that we offer applies to a lot of people, not just Latinos, you know. So, but, you know, maybe coming from a Latino, maybe that helps motivate some of our people in our community to start investing. So I thought, you know what, you know, let me start that and, you know, we'll see where it goes. You know, at the end of the day, it's just a hobby. You know, we obviously are not unemployed. We have our jobs aside from this. And that's kind of why it's a little difficult to post as much as we can on this channel because we have life outside of this. Aside from our jobs, we also have, you know, relationships that we have to, you know, attend to. So I figured, you know, why not just start sharing my stuff on social media and see how it goes and, you know, just be transparent because I think being transparent helps people and motivates people to start getting investing. They're like, well, if Mao and Danny can do it, you know, why can't I? You know, like let me follow them and kind of listen to what they have to say. And you know, right now we don't have a big audience, and you know, it's you know why if you think about it, you know why trust us? You know, you're 25, I'm 24, like we're just kids to some people, you know. or young adults still. So like who are we to go on and tell people, you know, this is how you should manage your finances? You know, like we're still young ourselves, but I think we listen to people that are already, you know, in their 50s, 60s, you know, who are already retired, and so we're kind of like trying to bring that information to our community because you know, we think it's valuable. You know, one of the biggest assets that our young people have is their time, and I talk about this all the time on the channel, is the earlier you start, the easier it'll be. You know, you can always start later. Yeah, you can start 10 years from now when you have more money or have a better job, but you know, 10 years of growth will really hurt you down the road because it just means you have to work that much harder once you get to that age.
Agreed.
But to go back to your question, yeah, I just wanted to start something and, you know, see where it goes, and you know, if we can even change one person's financial situation, I'd be happy with that. So
no, for sure. I think you touched on like the whole, like, we watch similar people on YouTube, right?
Yeah.
The Money Guys, Dave Ramsey, like whoever it might be, right? Like, I think just even having the representation piece of a Latino, like, behind the camera, and just, you know, to your point of like, if they can do it and they're like, you know, look like us or have the same last name as us, whatever the case may be, whatever connection they want to make, I think that's super valuable. And yeah, like, I think also the fact that we're super authentic and super real. Like, when you first came to me with this idea of like, let's start up a financial YouTube channel, and you know, let's give back to the Latino community. A big reason why I decided to go on this venture with you was because of the fact of how authentic I know you are, just from our friendship. And I know that that's something that I wanted to translate to the camera and to the people, of authenticity and being, you know, realistic and whatever the case may be. Because I think a lot of the times there might be some people on social media that perhaps aren't as authentic.
Right.
And if there's one thing that we could promise you guys, that is the fact that we don't know everything when it comes to finance. Like, we're learning as we go. Yeah. You know, 25, 24 years old, but one thing we will always do is be authentic and transparent.
Yeah, and I like how you talked about that, because that's one of the main points that I've been trying to point out with not only our YouTube, but you know, our Instagram and TikTok posts. You know, sharing the portfolio publicly, I think is a way of showing you guys that we're transparent and we sort of, you know, like, do what we say we're gonna do. And I think that's, like you said, like, that's the best way to go about it, because yeah, you know, you see all these influencers online that drive these fancy cars and, you know, live in like these crazy houses and have all this jewelry on, and you're like, damn, like, I want to be like that guy, you know? But sometimes, like, I came to realize pretty early on that, you know, that's all really fake. You know, people can go out and rent all this stuff, you know, and it's really easy to fake it, you know. But when you have public portfolios like this, you know, and sharing it with the whole world, you know, you know that this is real, and we really don't have any reason to lie. Yeah. Honestly, like, if I'm just being honest with you guys, like, we're trying to do this ourselves. So like, if by posting all this stuff, it kind of keeps me accountable. So you know, like, it keeps me like grounded and keeps me from doing all these like riskier stuff, so that I can look like those people driving those Ferraris or whatever. So
for sure. You touched a little bit about the fact that, you know, if you invest earlier, like how beneficial that can be. You know, if you start at age 20 as opposed to age 30, you can run the analysis on that, and it's a pretty big difference, right? Of how it would be from age 20 starting investing to 60, from 30 to 60, right? Can you touch a little bit about like when you started to invest, like how did your investing journey start, and kind of how you went about that?
Yeah, so I would say investing is very different than trading and all the other stuff that I was doing before this. So investing, I would say real investing, 2022, I would say, is when I started looking at, you know, market indexes and fundamentals of businesses, and actually putting my money in something that was a working asset, as opposed to speculating on whether it was going to go up or not. So that was 2022, but really I was introduced to this whole world of stocks and bonds and crypto back in 2018.
Yeah.
So I've known about this stuff for a really long time. But from 2018 to like 2020, so like right before the pandemic, I was doing like what you see at the beginning with all the people in the Lamborghinis and stuff like that. I was doing
get money rich.
Exactly. Getting rich quick
yeah.
schemes, and or maybe not schemes, but like getting rich quick promises from all these people. So they're like, oh, like just join my course or join my Discord, and I'll give you all the picks, and you just follow what I say, and you'll make money.
Yeah.
So I was in those Discords, so I for 3 years or 2 years I was there doing that, picking options, trading options, picking stocks, and I didn't really ever trade crypto in the sense that like I was putting a lot of money in there, but I definitely was in that space before the whole like crypto crazy in 2020. So I kind of, I was in there for 2 years, and it was kind of hard because I was still in college. That was the first couple of years of college. So, it was kind of hard to balance school and doing this because I had to wake up early. So I didn't really make any money at all. And I lost money. So then it's like, what am I doing? I'm sacrificing my own education to do something that I tried for 2 years. And I diligently tried it for 2 years, like every single day, waking up at like 5:30, 6 in the morning, 30 minutes before the market opens on the West Coast. And like, I had already analyzed what I was going to do the night before based on the group chats and everything like that. So I felt like I gave it a shot, and it didn't work, which, when you look at the stats and you look at the kind of stuff that I was doing, it makes sense. When you buy in anticipation of a stock option going up, like there's so much that can go wrong with it. Yeah. Not only does the stock have to go up, but you also need to be right by how much and by when. So like there's all these other factors that makes it really speculating, not really investing. So investing, I really started in 2022 when I started, listening more to like the investors like Warren Buffett, Charlie Munger, and all these other great investors like Bill Ackman too. So I started seeing how they beat the market, and I was like, you know what, this is what I wanted to do. And when you do the math, if you do it consistently for a decade, it makes so much more of a difference than trying to buy stock options and double or triple your money in a couple of days or a couple of weeks. Like the slow and steady approach is much better than trying to do it overnight.
Yeah.
So now, like, it's been 3 years now of doing this, and I've seen better growth in my portfolios and more sustainable growth. It's better for my emotional health than what I was doing before. But what about yourself? When do you think you started this investment journey?
Yeah, I think sort of similar to like when you started, like pretty much around our sophomore year was when I was first introduced to the whole like Robinhood was sort of my gateway app, as I'm sure many people.
Yeah, it is probably for a lot of people.
Because it's actually a really good app, but it sort of gamifies, investing, and it was that's what really attracted me to the world of investing. Like I could make $100 in one day if I bought Tesla or whatever at this amount of money, and the next day it went up, and I was just checking it every single day. And that's kind of how I started off my investing journey. I put some amount of money into Tesla, and I was in single stocks, and for about 6 months I was on top of the world. Like I was like, man, this stock is doing really well. I was up a decent amount of money, especially at that time, being a sophomore, junior in college. Like you don't really have a ton of money. You're sort of more not working, focusing on school. Yeah. And then there was a point in time where my portfolio just pretty much like went down, and I was in the negative for quite some time. And you bring up something of emotional and like mental health. I really felt like it impacted my day when I was going throughout, when I would wake up in the morning and I'd check my stocks in my portfolio, and I was down, $100, $200, $300. It would really impact my day of like how I went throughout the whole day. But yeah, that's sort of when I was introduced to like single stocks back in 2019, 2020-ish. And then it wasn't until 2022, similar to when you started with like the whole, from my side, that's when I got my job after college, and that's when I was introduced to the world of 401ks and employee stock purchase plans, and that's sort of really when I doubled down on my Roth IRA as well, because I had a lot of more extra disposable income before before I had graduated. So that's sort of when I first started off with my investing journey.
Sweet. And you bring up one of our favorite accounts on this channel. It's the Roth IRA. So how did you find out about the Roth IRA? Is it through your work, or did you already kind of know about this before that?
Yeah, I feel like it took me some time to really understand what a Roth IRA truly meant, and even kind of double clicking into that, why it's so beneficial.
Yeah.
I would say the first time that I really understood what a Roth IRA was in 2022, when I did my own research online and truly understood what it means to have that account, after tax dollars. You can take out at age 59 and a half without any, taxes, and sort of the benefit of that, it compounding tax free. That to me really stood out. And the biggest piece of the Roth IRA that attracted me towards that actual investing account was the fact that the government caps you at a certain amount per year. And I always think that if there is a cap to a certain investment account, then it must be really good,
Right.
And I think back when I started in 2022, it must have been around $6,000, $6,500 per year, and it's up to $7,000 this year now. So, and I think it started last year. But the importance of investing in that account has truly been good for me, and I understand it a lot more now.
Yeah, and earlier I mentioned the importance of time. That's one of our biggest assets as young adults starting this financial journey is our time. And I'm going through the numbers right now because I want to make sure I give you guys accurate numbers. But $7,000 is the annual limit, right, for this Roth IRA. So that means you could contribute up to $7,000 in a tax year. So from January of this year, 2025, to April of next year, 2026, up until that whole time frame, you can contribute $7,000 to your 2025 Roth IRA. So what would that be a month? Well, in a year, there's 12 months. Divided by 7,000 divided by 12 is 583.
83 bit, yeah.
So $583 invested for us. So we're 25, right? From 25 to the retirement age of 59 and a half, which is when you can start taking money out of this account without paying any sort of taxes or any penalties, would be 34 years.
Yep.
Is that what it is? Am I doing my math right?
Something like that.
We haven't done any of the calculations before this. I'm trying to make sure that we don't give you guys wrong numbers. So 34 years. So $583 a month invested. So maxing out your Roth IRA every single year for us would be 34 years of compounded interest. So let's assume that we do this, that we get a 10%, interest rate, which is historically what the market has been doing. So if we do that calculation, if we start now at 25, by the time we get 59 and a half, which is when we can start taking this money out, tax free, we'd have $1.7 million.
That's life-changing money, man.
It's a lot of money, tax free especially. And a lot of our viewers are like, oh well, in 34 years, $1.7 million is not going to be the same amount as today.
That's true.
So let's account for inflation, which historically has been around 3%.
Yeah.
So we take our 10, subtract 3, so let's assume a 7% rate of return in the next 34 years by maxing out our Roth IRA, and we get $897,000. I don't know about you, but $897,000 in today's money's worth in 34 years, I will take that, especially if it's tax-free.
For sure.
So even by doing the smallest thing of maxing out your Roth IRA, once you have a good job, this could be life-changing money when you get to retirement age, especially when you look at the statistics and the median, not the average, because you obviously have all these outliers that mess up the average, but the median, like retirement accounts at 55 is somewhere around like 250,000 or 300,000, like you're gonna have 3 times more than what the average or median person has in their 55 year.
For sure. And I wonder like what that would change like if you put the age as 20 years old, you know?
Exactly.
Like,
so let's do that. So
yeah.
so 20, if you start at 20 years old, maxing out your Roth IRA, which $583 at 20 years old is a lot of money. Like, don't get us wrong. That's a lot of money for us now.
For sure.
So let's assume that we have someone out there that's in their 20s right now, and they're able to max out the Roth IRA starting at 20. So that would give them 5 more years, based aside from our calculations. So that'd be 39 years total. So at the end, by the time they get to 59 and a half, they'll have $1.3 million in today's money. So just by starting 5 years earlier, you have, what is it, like
700,000? No, 600,000 more.
What's 900,000 of today's money? 897 to 1.3. You have $400,000 more of money just by starting 5 years earlier. So by choosing to start 5 years later, from 20 to 25, you're missing out on $400,000, which is a lot of money, but it is also a lot of money to start early at 20. Yeah. So let's assume that instead of starting at 25 now, let's say we wait 5 more years. Let's say, once we're 30, we'll probably have a good job, and then we can start investing more money. So that waiting 10 more years would give you only, 29 years of compounded growth. Mm-hmm. So if you start at 30 as opposed to 25, you would have 29 years of compounded growth at a 7% interest rate. You would have $600,000 in that account, which is still a lot of money, but that's a almost $300,000 mistake. Like, just by waiting 5 years, you missed out on $300,000 of today's money worth in the future. If we were to calculate it without inflation, then you're missing out on way more money than that.
And $700,000 as opposed to starting from age 20, right?
Exactly, yes. So, one of the biggest things you can do is, once you're young, you want to start investing that money in a Roth IRA. Yeah, you can't touch that money until you're 59 and a half, but, like, if you start small and start early, you're able to make it work, and you'll know that that's kind of going to be your retirement plan, or at least it's going to help your retirement, because, once people get, good jobs, they probably have like 401ks, or they have all these other compensation plans that'll play a part in their retirement. But just by knowing that you did your job by funding their Roth IRA, you'll be okay.
Yeah. And I think that like this sort of calculation itself is sort of what intrigued me into wanting to begin my investing journey a lot earlier. And it took me a while to really understand the power of compound interest, because it's the eighth wonder of the world, as they say. But that's what really attracted me towards wanting to start like investing earlier.
Yeah, and like we said, maxing out your Roth IRA at a really young age is really hard to do. Like if I were to go back 5 years, I don't know if I would be able to do that. That's a lot of money. But for those that are able to make it work, that you're setting yourself up for a really, really good future.
Yeah, and it might not be the full $583 per month, especially when you start young, you have the luxury to be able to perhaps contribute a little less than you normally would if you were to start a little later at age 30 and age 35, maybe even age 40. You're sort of playing catch up at those years as opposed to being more prudent in those early years.
Exactly. Yep. And I've run this scenario, and right now I'm using a compound interest calculator from the investor.gov. And, it's a really good place where you can play around with the numbers. You're like, well, if I'm 22 right now and I only have $150 to invest, or $100 or $50 to invest, like if I do that for, in a Roth IRA for the remainder of my time until I'm 59 and a half, like how much money would that be? So we encourage people to like play around with those numbers and find those numbers that work with you. Because we're looking at the absolute best scenario, the person that's able to match out the Roth IRA every single year. But, we're living in tough times. There's a lot of inflation going on. People's prices of things are going up. So it's really hard to find the money
for sure
to fund stuff like this. Because you already have high rent, high grocery prices. So how do you do this? So then play around with the numbers where you're able to find something that works for you. Maybe it's $50 a month, but something is better than nothing.
Agreed. And you bring up the sort of the state of the economy as a whole right now, and we're sort of in like these tumultuous times with the given news of whatever the case may be that impact the overall stock market. Can you sort of talk about perhaps the difference between a bull and a bear market, and also what your investing strategy is in both of those scenarios? Does it change? Does it stay the same? I think that'd be good to know.
Yeah, so bull market, to make it really, really simple, because we're assuming that people that listen to us
Yes.
are very new to the
Yes.
subject. So bull market in its essence is when stocks and the markets and the economy is going up. We see higher numbers for extended periods of time. A bear market in stocks is when you see a drawdown, when stocks are trending down for an extended period of time, especially when you see big corrections. Because there's a difference between a correction and a bear market. A correction can be a drop from up 10% from the most recent highs. A bear market would be a drop of 20%. So right now, I think we're around 10. I believe that's what it is. So we're in correction territory. But if it keeps going down, then yeah, we would enter into a bear market. And historically, though, bear markets last, not as long as a bull market. I think the time is somewhere between, like 13 to 19 months or something like that for a bear market, and bull market is multiple years. So more often than not, stocks especially are in bear markets. They're up positive more often than not. I think it's 8 out of every 10 years. It's stocks are up. 2 of those 10 years, stocks are down.
Yeah.
So when you have those kind of statistics, then you kind of look at it as like bear markets when you're young are actually like a good thing.
Yeah.
It's like going to the grocery store and everything being on a 20% discount. You would go in there and buy a bunch of stuff. Like if toothpaste was 20% off, you would start loading up on toothpaste. Because you're always gonna need toothpaste, right? So when you buy something that you're gonna need, or that is of value, you want to buy it when it's at a discount. And it's really funny when you talk about the stock market, because it has the reverse psychology of it.
Yeah.
When there's bear markets, people don't want to touch it because it's fair, like your money is losing value, and for the short term, it's going down. Your account value is going down, so you get these senses of like, oh, let me get out. I can't take the pain of losing money. But when you're young, you got to realize that your money goes farther. You can buy much more index funds or much more stocks of your choice, and you get them at a discount. So, and in bull markets is when everyone's rushing in for something. It's like you get the opposite psychology when it comes to discounts. When bear markets are in, everybody's pouring into stocks. Everyone wants to buy it. And you see it a lot with crypto. In crypto, you see the biggest swings because when people have money to spend, they start spending and speculating on stuff like this. That's why you see big bull runs on crypto when people have money to spend. Post-pandemic, when the Fed was stimulating the economy, people had money in their pockets. And so what did we see? We saw a crazy run up in crypto because people were just pouring money in. They had discretionary income to spend on stuff like that. And when people are feeling, inflation and all these other things that are eating at their budget or their money, they start pulling back on investments. But yeah, that's a very simple, explanation of what a bull and bear market is. We believe that you should buy regardless, whether it's a bull or bear market. I believe you should buy even more when it's a bear market. Like if you're putting in $100 a month, when the stocks are going up and then stocks start trading down, try putting in 125. 150 maybe, start adding a little bit more to it so that your money goes a longer way.
For sure. And I think people in bull markets everyone's a genius, right?
Exactly.
Like everyone, and I think you said it best, like everyone is smart. Everyone's a Warren Buffett, whatever the case may be. But in a bear market, it's important to be diligent and keep the same strategy that you would have normally, and perhaps even increase it. And that's what we do, right? I mean, I'm consistently buying into my current strategy every month, regardless of the current state of the market, because that is a proven strategy that has worked for many, many investors, and it's something that I'm going to implement in my life.
And so you talk about strategy. So Danny, kind of tell me a little bit about what your strategy is, because I think there's kind of some differences as to how we invest our money, and I think it's important for our viewers to know, because I think it's also good to bounce ideas off each other.
For sure.
This is something we're passionate about. So tell me a little bit about your strategy.
Yeah, for sure. I think if I had to describe my overall strategy like in a couple sentences, it's set it and forget it is sort of like my strategy. My investing strategy to some people may be boring, but to me it's sort of, I don't think about it at times, and I know where my money's going. So at a very high level, I invest a certain amount of my income into my 401k. And that comes with a match from my own employer. It may be different per employer, but if I had to give anybody advice when they're first starting off, at least contribute to the match, and then sort of add more as you go. But currently I do a little bit more than the match. And then my current employer also offers a ESPP, which is an employee stock purchase plan. And it's essentially a way and something that they give the employees of that company an opportunity to be able to buy into our company stock. And then the company itself either matches it or lets you buy it at a discount, as an example. So that comes directly out of my paycheck. So I don't see any of that money in my account, So it goes straight to my investment accounts, the ESPP, and to my 401k. And then we talked about the Roth IRA, right? I have a set amount of money. Currently I do the max, so $583 per month go to my Roth IRA. And that's all pretty much invested. The 401k and the Roth IRA are mostly index funds and mutual funds. And then the ESPP itself is a single stock. So it's sort of more of a diverse account, but like I said, you sort of set it and forget it.
Okay. And what kind of index funds are you buying in all of these retirement accounts?
The actual retirement account is managed by these like people. So the cool thing about my employer is that they give us the opportunity to have like that extra help. So we have these financial advisors that pretty much choose the funds for us. A big majority of my actual 401k is invested in a sort of retirement age fund, which is like a 2065 fund, that as you get older, the overall actual funds of the investment thing pretty much change. So right now, since I'm younger, they're a little bit more riskier. It's probably more of a split of 85% stocks and like 10-15% bonds. But as I get closer to retirement age, it'll sort of shift closer to a more stable account.
Okay.
Yeah.
And what about in your Roth IRA? So that's more of a self-directed Roth IRA, I assume. So you manage your investments in that account?
Yeah, but it's pretty much all invested into an index fund, into a mutual fund actually. It's FXAIX, which is more of a tech-heavy, pretty much tracks the S&P 500 for those stocks.
And do you have any taxable accounts or any like individual?
Yeah, I do have a brokerage account, and I'm currently investing into that. I have SCHD. Remember I was telling you about that?
That's a good one.
So that tracks the Dow Jones, but that's also, I believe, in an index fund or mutual fund. So
yeah, it's a fund. It's an index fund. So, but yeah, those are good.
What do you invest in?
Well, a lot of people already know. I mean, I'm pretty public about my stuff. But let me break it down kind of with how my money travels in terms of when I get paid and, how I distribute it. So when I get paid, I automatically get money transferred to a deferred compensation plan. Washington State has that plan. So, automatically, I think it's like 3% of my paycheck goes to this DSP or DCP, sorry. And so that's basically going to provide income in retirement. So 2-3% goes into that of my pre-tax salary. So that goes to that, and then my job, my employer has a pension still.
Okay.
So we don't have 401ks, but we have pensions. And I think for me, it's after 5 years of working there, I'll be vested into the pension. So basically, depending on how long I work at my employer, and what are like my 5 years of, I can't remember exactly how they're calculated, but it's like the best growth, like the best years that I've of income. So like or best months. So like if 1 month I earned 5 grand, like, and then next month I earned 4, like it'll take the 5, I think, best months, and it calculates it based, about how long I worked there, and then it gives me a certain amount of money for the pension in retirement. So that we don't have 401k, so I don't have any of that stuff. But after those two, then I have my Roth IRA. And I also max out my Roth IRA every single month. So what I do is I contribute about $2,000 a month to my investment account. So I have my Roth IRA, which is self-directed, and an individual brokerage account. So aside from the pension and the deferred compensation plan, my post-tax money goes into Roth IRA and individual accounts.
Yeah.
And this is for me. My wife has a different structure because she works at a different place. But in my Roth IRA, I hold index funds and individual stocks.
Yeah.
So you invest a little bit more safer, I would say, than me. I would say my investment strategy is also pretty well cemented in something. It's not like I'm speculating. There's more risk to it, but it's not what I was doing before.
For sure.
It's buying individual companies buying stock of individual companies that I think are going to be around when I retire and that are profitable. So there's a specific strategy with how I pick my stocks. And, if you guys follow the Linktree and, the YouTube and all this stuff, there's a PDF of how I highlight and kind of what I look at. But a big portion of my Roth IRA and my individual, because I kind of lump them together, because one of the things I've realized that once you start adding money to all these different accounts, it's really hard to track your net worth. So I made it so that everything is with Charles Schwab. So I have my Roth IRA and my individual account all together. So the aggregate amount you guys see me post is of both. But if you look down, there's a subsection that shows how much is in my Roth and how much is in the taxable account. But the investment strategy is the same. So I have index funds in there, S&P 500 index fund. I'm also buying into a tech index fund too. But then I also hold individual stocks like Amazon and Google. And these are not buy recommendations. I'm just telling you guys this is what I hold. I dive into their fundamentals. So I pick those individual stocks. My wife has it set up more similar to you.
Yeah.
She has a 401k through work, or 457, one of the two, I can't remember.
The 403B? Maybe?
Or 403, I don't know.
The healthcare one, right?
Yeah, the healthcare one, yeah. So she adds money to that. So she has her retirement account through work, through that. And then she has a Roth IRA, which I manage.
Yeah.
So, and I manage in the sense that, like, I set it up so that it automatically buys S&P 500 and a tech index fund every single month.
Yeah.
And that's one of the things that I'd recommend everyone to do is, like, there's a lot of steps when it comes to, like, setting all this up.
For sure.
But one of the biggest hacks that I've realized, and something that makes it really easy to get started investing, is to automate everything.
Yeah.
So when I get paid, everything gets distributed to my accounts right away. So I don't really see that amount. So, like, when I get paid, I'm like, oh, like, I have this much money. But I know that that's how much money I have for bills and spending. I know that my retirement accounts, my investments have been already taken care of. So one of my biggest ideas is that if you never see that money in the first place, you never really feel like the pain of losing it, in the sense that, like, you have to plan for retirement.
Yeah.
So, like, if you never see it in the first place, you never knew you had it.
For sure.
And in a way, you're kind of already prepping yourself up by just setting and forgetting and then letting it do automatically.
Yeah, and I think you bring up, like, the fact of how different our own investing portfolios are. There's no right way to sort of we both have that ultimate goal of wanting to build the generational wealth, right? And there's no right sort of way of doing that. And there's also, every investor has a different tolerance for risk.
Exactly.
Right? So it's important to understand sort of what your tolerance for risk may be, and then making sure that that's reflected into your own individual investing strategy, right?
Yep. And to go off of that, risk is one thing that all investors try to minimize. We try to minimize our risk and try to maximize our reward.
Yes.
Our return. So with index funds, like I would say index funds, if you're looking to get started, I'd really recommend index funds for someone that doesn't really want to care about like staying up to date with market news. Because when you buy index funds, you just buy every single month and you just add money to it and you don't have to worry about it. Like you know that you're planning, you're doing your investments, you're planning for retirement, all this other money that you have after that, then you can focus on spending on your bills and living your life. Because we want to have a balance. You don't want to be so crazy about always saving money to buy index funds, because what kind of life would you have after that? How are you gonna then have money to spend on trips, and stuff like that. So having a balanced life is really important. But if you're an investor and you're looking to start getting into this stock market, then and you want to really like pay attention to company fundamentals, earnings calls, all this stuff, then if you want to start off picking individual stocks, go ahead. There's more risk to it.
Yeah.
For sure. And if you're starting, I definitely would say keep it very small. Keep a big chunk of your portfolio be index funds, like tracking an S&P 500 or the NASDAQ, or the Dow Jones, and start small with those individual stocks, because at the very beginning, at least for me, I was also buying stocks that were not profitable, that the story behind the stock was much more important than the profitability of the company, which now my approach is much different than that. But when you first get started, you get kind of wrapped in this idea that the stock is going to create the next best thing, and so you start putting a lot of money into it, and next thing you know, the stock goes down and the company goes bankrupt. So if you want to start with individual stocks, then start small, start with well-known companies, start researching why a stock price goes up for individual companies. But if you don't want to do any of that work, definitely stick to the index funds.
Yeah, no, for sure. And I think within my own portfolio, I have like over the course of the past 2.5 years, I've been able to build up more of that exposure to the individual stocks through my ESPP as an example. But the fact is, I work for that company, so there's sort of a motivation, to be able to help that company perform better when it does come to our earnings call, when it does come to whatever the case may be, right?
Yeah. So. Yeah. Well, what would you recommend someone that's looking to get started in investing? Like, say there's one person out there looking at our video, and what's one thing you'd recommend them?
Yeah, I mean, I think, if someone's watching this video, I think there's an interest for finance. So I think really, really obsess with finance, if you will, because at least that's really what sort of put me on that journey, watching YouTube videos, just really learning about the what finance and what investing truly is. I would say, do your research on that side, whether it's watching us, whether it's watching other people on YouTube, other financial groups, whether it's reading some books. That's sort of what really triggered me into wanting to put some of my own money, put some of my own skin into the game. So reading some books of like The Millionaire Mindset, The Psychology of Money. Those are just a couple of books that were really good. And I think the biggest thing, and we sort of touched on this in the beginning of the call or beginning of the podcast, is understand your why. Understand what fuels you and why you want to be able to start something really for anything, right? But especially for investing, it's important to know what you want to, what the outcome is of this new journey that you're going to be going on. For me, I want to be able to build generational wealth, and at the same time, hopefully pay it forward to the programs that helped us, as an example. So that's sort of my why. And it's okay for the why to be changed in different stages of life, right? We're 25, 24 years old. Someday we might move into the category of being dads or being fathers and being a husband. And as we get older, so perhaps the strategy or the why might change a little bit then, but having a strong foundational why will just make sure you keep coming back to that, and it'll fuel you into wanting to learn more and to get better at it.
You mentioned the psychology of money. I will say that was like one of the first books that I read that really shifted my thinking. I went from like trying to really beat the market. I mean, not just beat it, but like get rich like in a year type of mentality to like like that's really very, very uncommon, and most people lose money before they they lose a lot of money.
Yeah.
And there's a very small select few that actually do make a lot of money from this. So reading The Psychology of Money as was like one of the most fundamental shifts of my thinking. So I'd recommend that book out there for you guys. Find it anywhere on Amazon. We're not affiliated with anybody. We don't get paid
we don't have
for
sponsorships.
Yeah, we don't get paid for anything. So we just are two guys that like talking about finance, and we always bounce ideas off each other, and we hope we can motivate our community to start investing and also pay back to the programs like you said.
For sure. And for me, the one that comes to mind was the baby steps, 7 baby steps from Dave Ramsey. So that's sort of when I was like, how I work is I want to be able to have sort of a set plan of how to be able to, perhaps build a better financial perspective. And I think those 7 baby steps were really, really good, especially if you have debt as an example. They offer a very, very good way and a very clear path to be able to sort of, get to generational wealth, if you will. And some people may disagree with that, but I think when I first started off with my investing journey, those 7 baby steps from Dave Ramsey were helpful to my growth.
That's good. Yeah, I agree. I listened to Dave Ramsey before, and he's got some good stuff in there. Yeah. Definitely. I mean, he's helped millions of people, so there's obviously some truth with what he says. So, but yeah, I mean, I hope is there anything else you want to share with the audience? I did want to ask you, how big of a crypto guy are you, Danny? I've already given kind of my thoughts on crypto, but let's see what the person behind the camera says.
Well, I'd say, I'll preface this by saying I have a very small percentage of my portfolio that is exposed to crypto, maybe less than 1%. But crypto itself is a very polarizing topic, depending who you ask. There are some people who are very, very, interested and want to put a lot of money into it. And there's some people that are on the very opposite side of the spectrum where it's like, that is the dumbest thing you can do. I'm sort of in the middle in terms of I don't think that you should have a majority of your portfolio invested in crypto. I think it's very volatile, and personally for me, this comes from I'm a very risk-averse investor. As you've seen through my investing portfolio, I'm more of a you set it and forget it, index funds, mutual funds, a lot of exposure to the overall market. So if you have a lot of exposure to crypto and you're okay with that, sure, go for it. But I would advise to be more, less risky when it comes to crypto, and maybe have 5, max 10% of your portfolio invested in the overall crypto market. Just because from my own perspective, I'm not too informed on the overall crypto mania, if you will, and sort of what gives value to crypto, and why it goes up, why it goes down. I could not explain that to you. And I think for me, I would just rather not be as exposed to it. But that being said, there's been a lot more talks, especially within the US of becoming the crypto capital of the world and all these different things. So who knows what's going to happen in the future? That's something that I think I'll keep a close eye on. But if crypto does kind of take off, then perhaps I would be regretting and kind of punching myself a little bit if I didn't invest so early. So it's a very polarizing topic, and I don't know if that was helpful what I just said, but all that to say is, personally, I would only have maybe 5, max 10% of my own portfolio in crypto.
One thing that I want to highlight that Danny just said is that we don't know what's going to happen with crypto. We have people out there saying that this is going to happen, or that crypto is going to be, or that the US is going to be the crypto capital of the world or whatever. But we don't know,
Yeah.
we don't know until things actually start to unfold. So when you start putting money into stuff you don't know, it's not investing. You're not investing in an asset.
And we're taking just a risk.
You're speculating, which is okay.
Yeah.
I think people should be able to speculate. If you want to speculate, go for
Yeah.
it. But like you said, don't make it more than 5 to 10% of your account. Don't blow up your whole
Nest
account
egg, yeah.
trying speculating on something that might not even happen. Go for it. Buy some.
Yeah.
But be understanding of the risks, and not. Sometimes, like as we've seen, like cryptos are very volatile, very volatile. I don't want to call it an asset, a very volatile sector, because they see the price swings all the time. So, if you want to buy, just don't buy at the top because crypto really does not provide any sort of income in any way like stocks or even real estate does. And we'll talk about a little bit more about it if you're okay with the other forms of investing.
Yeah.
But crypto, what you pay for a Bitcoin depends on what someone else is willing to sell it for you, or vice versa.
Yeah.
So like there's nothing behind it fundamentally that gives it value. I guess you could argue the blockchain and all this other stuff, and the adoption of its use, but
and the scarcity, perhaps.
But like at the end of the day, it doesn't provide any income in the way that stocks do. Like at least with a company that's profitable, like Amazon or Costco, like these are companies that if you were the sole owner of Costco, you would have a cash. You would have cash. You'd be the owner of the incomes. You'd be the owner of the cash. Whereas with crypto, if you owned all the cryptos, you're just the owner of a bunch of coins that, for what? Like what makes crypto valuable? The adoption of it. So like we don't know whether it's gonna be adopt to the level that it's pricing in right now. So,
for sure.
So if you want to speculate, put money for it, but just don't make it more than 5 to 10%.
For sure, and I'm all about diversification, right? So we're not saying don't invest in it, but I think from my own perspective, and perhaps you are more on the single stock side, right? And I might be more on the mutual funds, index fund side. But we both you have mutual index funds, and I have single stocks as well. And that's part of being diversified, right? You can't put all your eggs in one basket. And I think Bitcoin and crypto is another piece to your diversification. But just don't make it 100% of it.
I agree. All right, guys. Sorry about that. I guess there's not enough memory in our disk. We've been yapping for too long. So let's wrap up this yap session. I know Danny got cut out there, but if you guys have any want to know what he was about to say or have any questions, go ahead and drop them down. But thank you so much, Danny, for coming on, and thank you guys for watching the channel. I hope you guys found this some sort of fun and informative podcast style video. Thank you so much, Danny. And you have any final remarks?
No, I mean this was great. Thank you for having me on. I think it's the first episode of a hopefully awesome series. So looking forward to the next one.
Yeah, and don't forget to follow us on all of our other social medias, guys, and drop any comments you guys have in the comment section. We'll do our best to answer them. So we look forward to posting more content with both of us and with Danny. So it'll be good. So stay tuned. So hasta la próxima, mi gente.